are they doing? That big drop that occurs. Let me say this. This might not occur in price, and if it doesn't, you do nothing. But if the market does drop, and all things being equal that I've outlined here, these are the things I would do to get into a trade. But that rush for retail or street money traders, the people that don't know what they're doing what? They're selling at the market. Sell, 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 sell. So what is actually occurring? They're drawing in and engineering sell side liquidity. Why would they do that? Because they want to buy it. They have to have sellers at a lower price. Oh shit, the tumblers are turning, aren't they? Woo! You're getting there, aren't you now? You're learning some shit. Never expected that on a Sunday. Some of you are listening to me in your headphones right now, and you're wondering if the person next to you at the church pew thinking, did he just hear ICT this holler and whistle? They're probably listening too, don't worry about it. So you're looking for sell side liquidity when you're bullish in a buy model, in a Judas swing that's going lower in a high impact or a medium impact news driver, or you're looking for a BISI, a buy side imbalance, sell side inefficiency, where it's like a fair value gap, where the candle that we'd be focusing on would be a bullish candle. Okay, so fair value gaps are the classification. Okay, that's the imbalance. And to set this record straight, it is not in any George Engel books. There's a fucking clown out there trying to say that this is taught in George Engel. In fact, I'll fucking prove it to you. I'll thumb through real quick and show you there is no fucking reference to a fair value gap in Winning in the Futures Market by George Engel. Okay, I have the book. You can look at it too. It's on fucking line. It's not in there. $500,000. Find my shit anywhere before 1996 in print or in video. Anywhere. You won't fucking find it. Go fuck yourselves. So you're looking for one of two things. If you're bullish, you're looking for sell stops to be rated or engaged. Or if you're looking for a fair value gap, preferably if you're trading Forex, it's preferably less than 40 pips below the market price. In other words, the market price being right before the news event comes out, or preferably below 30 pips. Okay, so that factor further increases. Let's assume if you're bullish and say London, we'll ring in London too, because this is what makes New York better, in my opinion. You have the added benefit of knowing what London has done. Let's now say that we had a previous late session low in pound dollar the day before New York midnight for today's hypothetical trading day. And overnight in London, we traded down below that, and then we had a nice reaction higher. And we drifted back down, and say that drifting back down is inside the leg that was created from the London low to the market price prior to the news report coming out at 8:30 in our hypothetical example where we would potentially be bullish on pound dollar. These things are further amplified in terms of odds in your favor, because now you have that likelihood of the London low of the day is in place. And now you're not going to see much of a retracement lower in that leg, because they don't want to get close to that low. It's already locked in. So they're going to be reaching for a higher time frame buy side liquidity pool, or where that weekly chart's reaching for. It may not reach for it and arrive at it that particular trading day. It may require another day later in the week, because we're looking at a weekly expansion. The weekly candle is generated over what? The course of the week. That doesn't mean that it can't happen where the largest expansion occurred on that one single day, whether it be Monday or Tuesday or whatever one particular day it could have been. All the movement can be done with a report day, and then could be quiet, before or after that particular event. So you have to have all that factored in, which is why it's important to only be focusing on medium or high impact news drivers, because you will be less likely to miss the moves if you do that. Now, it doesn't mean you can't trade on days without high impact or medium impact news drivers. It just means that all things being equal, and whatever's in motion will tend to be in motion until we get to the report day. Or in layman's terms, if it's been bullish and a buy side liquidity pool hasn't been reached yet, if there's an absence of a medium or high impact news driver on that particular trading day, I'll still trade long. And that's fine. I just won't push my maximum leverage. I won't pyramid a lot in that particular type of day, because it might not create a lot of movement. So why should I build my positions large? I want to do that. And once I've seen the manipulation, it showed me its hand, like a poker table. Okay, I've seen my player's hand. So now I'm going to play mine strong. I'm going to go all in. I'm going to build and build and build, because I'm on side. I'm on the right direction because of my weekly analysis. It's indicated to me that they enticed the street money to come in going short at a time when I'm looking to go long. And one of two factors I'm looking for. I'm looking for sell side to be taken. If it's too far away to reach for it reasonably, then I'm looking for a fair value gap. If it doesn't have a fair value gap, here's a third. Okay, because just like on roulette, it's not red and black. It's red, black, and green. And green can fuck the whole show up. Green is there is no fair value gap, and the low is too far away to consider. It's beyond 30 or 40 pips below the market price. So what do we do then? You wait. You wait for the market to create another run higher, short-term high. It trades back down, and once it breaks that short-term high, now we have a shift in market structure. Follow the narrative. Do everything I just outlined before. Look for a fair value gap or a run below low and submit to it. You might have to do a secondary trade with less leverage if you get burned on a fair value gap entry. But that's my 2-trade rule on it. And if I lose on both, I'm done. I have to wait for the PM session, or I just simply stop for the day. That's it. Is that complicated, folks? Now, for someone that's new, now I'm not going to be unreasonable here. For someone that's new, the terms I'm tossing out here and some of the logic I'm saying, if you've been around me for a while, you know, this might seem like, wow, this is really complicated. Just give me a fucking moving average, pal. Give me a moving average and a stochastics, man, and call it a day. This is too much PhD shit, piled higher and deeper. No, this is algorithmic principles being articulated in a straightforward manner, right to the fucking point. You asked for this shit. Now you have it. What are you going to do with it? That's what I'm interested in. And then obviously you're just going to submit to the draw on liquidity based on that weekly chart. Now, there are smaller draws on liquidity in the intraday charts, and you see me referencing them all the time. Why do I do that? And why don't I do that with the weekly chart? Because that's the work you're supposed to be doing. How many trades have you seen me share? How many things have I articulated before I even put the trade on? I say, okay, here's the direction I'm looking for because I'm looking at a particular price level. I'll say, note this on your chart. So if it's above the market price when I'm tweeting that, is that bearish? Fuck no, it's not bearish. And there's people still out there thinking, well, why'd you go long? Aren't you bearish? What the fuck would I be looking to go short for if I'm pointing to something 30 fucking handles above the market price? How is that fucking bearish? That's an unrealized objective. It's below where market price is. That means I'm fucking bullish. I'm looking for a reason to go long. It might not be there yet, but I'm looking to get up there. Vice versa. If I say, here, note this on your chart, and it's below the market price, that means what? I'm bearish. I'm going to be looking for something. Looking for what? Some of this shit I just outlined here. Not limited to, but that's predominantly what I'm trying to do. Looking for a way to on-ramp and get a ride to that, okay? Or build a bridge to it. And that's what I do in the morning. Now, it took more time for me to outline it, explain it, give you different, well, instances where you might have to contend with certain things and certain factors and weigh out whether or not you want to do something. But by far and large, it cuts right to the meat. Trims all the fat off, all the bullshit. It goes right to what are you trying to do? And folks, let me explain this to you, okay? If you doubt what I just gave you is not fucking platinum, go back and look at every fucking move in the last 6 months. And you're going to see one of those two instances. And for the assholes to say, oh, but it didn't work here, use the alternative things I've told you, and you'll get it. Period. If you lose on the day, you must consider using half of what you risked in your next trading day, whatever that trading day would be. If it's the next trading session, if it's the next trading day, if in other words, if say you were trading 10 contracts in the S&P and you lost, okay, on your first trade. Then you drop down to 5 contracts on the second trade. If you lose on that, you're done for the day. You cannot take another fucking trade. I don't give a fuck about 5 trade fucking Larry down in fucking Texas, okay? You stop.